Hello, welcome to this video on how to create financial models. I will be a bit fast. So I'm starting from a blank Excel sheet, blank Excel file. And so this is my own preferred method of creating the template of the financial model. I usually create a cover or summary sheet. Then I add table of content or index page. Then the historical income statement, then the historical balance sheet, then the historical cash flow, and then for the income statement projections, sometimes you might want to use multiple sheets, but for this demonstration I'm going to use a one sheet income statement projections ratio. So income statement projection ratios. Similarly for the balance sheet, projection ratios. For you, when doing financial models, you will not project the cash flow. So you're going to extract the cash flow from the income statement and balance sheet. So with these income statement projections and balance sheet projections, I'm going to create the income statement forecast. I'm going to create the balance sheet forecast. And if you are following the IFRS standards, then you should be aware of the naming convention. So income statement is going to become statement of profit or loss. Balance sheet is a statement of financial position, where cash flow still remains cash flow. So cash flow forecast. Then after doing this is where if you need to do the valuation, then you want to have a valuation sheet. So sometimes you might not want to do valuation. Maybe you're just wanting to do your forecast for internal planning, so your entire financial statement forecast. In that case, you will not need to do valuation. But then I'm going to also, in case you need to know how to do valuations, I will get to the stage of valuations. And some other times you will also want to financial ratios, which help you to be able to compare different companies in across an industry or different industries. So who is giving better return on asset, return on equity, all those performance ratios, right? Okay, so I'll be a bit really fast. This is my preferred way of creating the cover page. So I pick a rectangle, make it the name of the company I want to model for. So for this demonstration purpose, I'm going to do for Dangote Cement PLC. And usually I put some information, so maybe by my name, and then maybe last updated, today is 9th September 2019. Then any other information you would like to make people see directly on the cover page. So sometimes I might also want to show things about the company's financials, maybe stuffs like so the revenue. Might want to show the EBITDA, might want to show the net income. Okay, I might want to show the current assets. I might want to show the current liability. I might want to show total assets. I might want to show let's say I use this approach. It's current assets, non-current or fixed assets, then non-current liabilities, total liabilities, then the total equity, and maybe I'll add three more. So net cash flow, free unlevered free cash flow, UFCF, which we use in doing the discounted modeling, the discounted cash flow modeling. So maybe these are things I would like to show, and show them for different years. So I'll come back to this. Let's just, by the way, let me save it. So I'm going to call this financial model for Dangote Cement. So I'm going to save this in my document. Now, as for my table of contents and all of these other sheets, I have an approach that I use to create a uniform look across everything. So I pick this first sheet, then I hold on the shift key, I pick this last sheet, and then I do some common things I do a lot, which is the name of the company I'm modeling for. So I do this is equal to, I come over here, I pick the name of the company I'm modeling for. I also always like to keep this in italics. Then also the last time I updated this model, so it makes it easy for whoever is using the model to see when this was last updated. So I can do this, and I also like to create like a title on each of the specific sheets, right, to let you understand, oh, this is for the income statement forecast, this is for the whatsoever it is that's on this sheet. So it makes it easy, and also when you print, you'll be able to detect that this is what it is, because it will print out. The sheet names don't print when you send this to printer, so it's whatever I write here that makes it easy for you to understand where you are. So my approach is well, I'm a Nigerian, so I'm going to use our color. So I pick maybe green. I want the font to be white. Then I also want to increase the font size. Maybe 16 is good enough. I make it bold. Then one other thing I want is I want whatsoever title I write to center across. So I'm going to right click and then go to format cells. I go to alignment. I come here, I pick center across selection. I do OK. Any other thing I like to do on this? So that is all. And then once I'm done, I'm going to come over to a sheet that was not part of what was selected, and I'm going to now go here and start with my work table of contents. And one approach I use for my table of content is I make it navigable, like hyperlinks. So I guess maybe there are 10, or and then I start historical income statement, historical balance sheet, historical cash flow income statement projection ratios, balance sheet projection ratios, the income statement forecast, the balance sheet forecast, the cash flow forecast, the valuation itself, and the financial ratios. Then I make all of this clickable, meaning I'm going to right click, pick hyperlink or link, whichever shows for you. I go to place in this document. I say this should go to the historical IS, and I repeat similarly for all of these. Balance sheet, cash flow, income statement projection ratios, balance sheet projection ratios, income statement forecast, balance sheet forecast, cash flow forecast, valuation forecast, financial ratios. Okay, and another thing I do a lot is whenever I'm done, I prefer those old sheets to not have these busy lines. They are called grid lines, these lines crossing horizontally and vertically, right? So to do that, I go to view, I disable grid lines. Since I'm done also with these sheets, I do likewise. So it makes the model a lot neater. Okay, and so now I move to the income statement, the historical income statement, historical income statement. And so usually for any company you are modeling for, well, a company that exists before now, you will have historical income statement. So you just go copy that and paste in here. So that's what I will do. I already have extracted it from their financial annual reports for Dangote. Dangote is a publicly listed firm, so that makes it that all of their income statement and financial statements are publicly available. You just go to their website, investor relations, and you can download. So I've already done all of that extraction. I'm going to just copy paste. So after pasting, to make the size, the width be the way it already is here, you notice these places are not well aligned. I just go on this control here and I pick keep source column width, so that auto adjusts to how it was where I'm copying from. Okay, so now I've brought in the historical income statement, so I save that. I go also to do likewise for the historical balance sheets. So historical balance sheets, I also paste and I tell it to keep source column width. I do likewise for the cash flow, historical cash flow. I paste, I copy, I come here and I paste. I tell it to do keep source column width. Okay, and like I already explained, I prefer to turn off the grid lines so they look a lot neater with the grid lines turned off. So I do likewise for this. I say this is the historical balance sheets. This is the historical cash flow. I also turn off the grid lines. Okay, so you see they look a lot neater that way. Then instead of me having to redo most of the things I want to show here, right? So I want to show for the next couple of years. So say we are we're in 2019, so the last actual I have is 2018. So 2018 plus 5 more years, plus 5 years. Let's see what that comes to. So that comes to 2023. So I'm going to want to do this to 2023. 20, let's see, 2023, 2022. I can pick these two and circle backwards. I hope I have data as far as that. Okay, so this is good enough, right? Then I can let you be aware that these are for actual years. So one quick way of doing that is I go to format cells, I go to number, I go to custom format, and I say you should put an A in front of it, so it makes it easier for you to know that those are actual years and these are my forecast years. So to do for my forecast years, I also go here to custom, and then I pick this 0, I put an F in front, so that way you can easily know which are the actual years, which are the forecast years. And then I'm going to make this bold. I'm going to make it have a horizontal bottom border. Okay, so we are making progress. I'm also going to make this have the comma separated formatting. Okay, so right now I'm here at the historical projection ratios. I'm going to call it that historical, income statement projection ratios. That's really long. And what I want to make possible is that you should be able to select scenarios. So the things that drive a company's entire financial performances are usually how much revenue they make and then how much of it they're able to retain as profit, meaning revenue and expenses. So purely much like all of the things in the income statement, they ultimately drive the performance of a company. Every other thing are usually a factor of these and how well the company is utilizing their resources. So what I'm going to do right now is I'll create a scenario picker here, so we can create different scenarios for different assumptions, things like best case, worst case, and the base case. So I'm going to say select scenario. No one knows the future, so whatever plan we make towards the future, we are at least giving ourselves some margin of error and say maybe what we have laid out can best be described as a best case. So what if things don't happen the way we expect, so a worst case? And then maybe what if maybe things are in between, so like a base case. There are many ways to do this, right? I'm going to use there's a way that I use a lot more in the class, in the trainings I do, and then there's another way I use for my commercial project. So in this video I will use both of them. I'll show you how to do both, but then I'm going to leave the one I use in my commercial work because that one looks a lot nicer to implement. So in my commercial projects I typically use the combo box. So you see I have a developer tab here. You probably won't have it unless you have enabled it. So if you don't have it, you need to just go to file, you go to options, you go to customize ribbon, then on this right side most likely yours will be looking like this on disabled, right? So you enable it and then you do OK, and then you will also be able to have developer. So when I do developer, I go to insert, I pick a combo box. So when I pick the combo box, it turns into something that makes it possible for me to draw a box like this. So when I draw this, maybe this is too Okay, so maybe this is good enough. And then I right click on it. It allows me to be able to set, how the things will work, right? So for it to work, you go to format controls. It will ask you for input range. It will ask you for cell link. So right now I can go somewhere that might not be too visible for my user. So I can pick maybe this cell AA, and I'll say I'm going to put my input links here. So I want to give you three options. So let's say I put them here. Then cell link, whatsoever you pick, I want it to be reflected here. So I can say it should only make it possible for you to see three options at once, like drop down lines, three items. So I do OK, and then I can complete that by saying this is best case, this is base, and this is worst case. And from this moment forward, those are the options that will be here. When you pick best case, you will see that this will indicate what you have picked. You've picked the first of the options. So this is what I use a lot in my commercial jobs. But then there's the other option where I do, so there's the other option where I do data validation, which is I click inside here, I do data, I do data validation, I pick lists, and then I can type the option. So I can type best, comma, base, comma, worst, and then I can also pick, right? So whichever it is you want to do. Since I've already typed it in that other cell, in these cells here, I think I should also show you how to pick. So you can pick, and then once you do OK, then you have similar experience in terms of this will be there. Why I prefer this for my commercial jobs over this is, you see this, the drop down shows always this until you come here before the drop down will show, and so that's why I have that preference. So whichever you do, they will work, right? So right now I'm going to just put this right here, so we use this approach. Now for the income statement, all the different lines as we have here, we want to do their projections, right? So I'm going to pick starting from the past, here is good. I tell it to expand. You'll notice the years have gone, they are looking not the way they were here. So what I will do is to make it easy such that whenever a new year has come or you have a new financial year, once you update this, right, you want the years here to start also counting from there, right? So what I will do is I will say that I want to pick the last few years. So I say this equal to here, the last actual year, and I can drag this backwards to get me, and then I can do this forward +1 to get me the future year, and we go 2, 3, 4, 5. So typically you want to forecast 5 years at least into the future. So that I'll go with that approach of doing just 5 years into the future. I'm going to just slightly increase this, and I want this to show as future forecast. So I'm going to come here, and like we did the other time, I'm going to write an F in front, so that way showing as forecast. Some other times I also like to give it a different color so that it makes it kind of easier to spot that those are the forecast, and the ones in black are the historical. All right, so now every line on the income statement we need to forecast. So we need to forecast the revenue, we need to forecast other revenue. So let's start with the revenue from sales and services. I'm just going to call that main revenue. I can simply copy it and paste since that might be faster. I come here, I paste that. And so how do I want to forecast it, right? So first of all, let's go bring in the actual. So I come in here and say this is equal to 2012. I drag all the way into the future. I tell it to retain the comma separated style. So for revenue, if I don't have internal records, if I don't know what the plan of the company is, one rule of thumb is to just say we're going to forecast the revenue on a year on year growth basis. So typically when it comes to forecasting, there are two general approaches you will you will you will take, right? So when it comes to forecast, you will want to maybe, you know, pick from a schedule, an existing schedule or plan. So if I have a revenue schedule that shows all the breakdown of the product of the company, and then maybe the unit economics, how many units of each product they plan to sell, and then all like that for the next 5 years, then I will want to use that. Or if I don't have, then I will want to pick like a ratio, a forecast ratio. So I will want to use a forecast ratio to project whenever I do not have this. So this is like you prefer this, and this is when number two is when you don't have a plan. The company didn't tell you their schedule, their plan for the future. They didn't tell you, they didn't give you what it is they plan to sell per product type, and then you can sum them together and come up to what the revenue will be. Then you want to use a forecast ratio. So I do not work with Dangote Cement. I don't have any insider knowledge. I don't have access to their schedule. So I'm going to use the forecast ratio approach. Right? If I have the schedule, what I'll just do is I go and pick from the schedule and paste verbatim here. I'll just paste or link to the schedule directly here, and that way it will show whatever it is the company has planned by all of these different line items. So for our case, I'm going to do a year on year growth percentage. Okay, and so year on year growth means, you know, how the company has been growing over the last year. So it grew 29% in 2012. So I drag this forward. So I'm going to remove this anyway. This is just to explain that we will always like to create the forecast using any of those two approaches, and preferable is you use the schedules if there is a schedule. Okay, so now how do I make all of these linked to how do I make all of these linked to the scenarios? Okay, so I'm going to say for the different scenarios. In fact, I can go copy them here. See. So what will happen in a best case scenario? What will happen in a worst case scenario? Say for best case, worst case scenario, nothing. For the past, you cannot forecast for the past, so I'm going to make it obvious that you cannot forecast for the past. This is my own preferred way of doing this. I right click format, go to fill, go to pattern style. I pick this pattern. So that makes it obvious that you are not supposed to provide anything for that period. Then I also include a note. So whatever assumption I use, I make it really obvious for the users of my model to be able to see. Okay, so okay, I can decide that for the best case, I'm going to use average of the last 4 years. So average of the last 4 years growth, 1, 2, 3, 4. So this is called moving average. So I'm always going to be using the average of the last 4 years. So if I do average of the last 4 years now, it will be this, this, and then this, this, average this, and this, average this. And so that's it. Then I go to my note and I say I've used the 4 years moving average. That way there is transparency in my work. If you do not agree with my assumption, you can go and change and update the note. And then I can decide that for the best case, I do the base case plus maybe plus 10%. Plus 10% would be a lot, right? Let's say plus 5%. And I can say worst case is base case minus 5%. Now, if I want to make it easy for you to use such that you can enter 5% here and then I'm linking it into here such that if you disagree with my assumption, you want to change this to 10%, you just come here and type 10%. So we can do that. I can say 5% downwards by 5%. Right, then I come here, I right click, I go to format cells, I go to custom formats, and then what I'm going to do is I'm going to say in quotation mark base case plus. I'm going to copy this because I'll need it again, so that begins to show here that way. I'm going to repeat similarly for this. So I'm going to say it's base case minus. Okay, and then I'm just going to say this plus this, and I make it absolute so that when I drag forward I would not have issue. So that way I do for all of these, and then I do likewise this minus this, I make it absolute, and then I drag forwards also. So that way I have done for all of the two scenarios. Now what I want to happen is whenever you pick a scenario here, that is what it should apply for the future. So how do I do that? Okay, I can use index and say, you know, whatever you pick, so whatever in this list, whatever you pick which is identified by this number here, right, that's what it should use. Okay, so but I don't want to write the word base. What I want is the figures. So it means I'm going to do index, and this time around those figures, right? And then which one did you pick? If you pick base case, it will be 2 here, right? And because I intend to drag this, I'm going to make this absolute. When I drag this, that's how it will work. So if you go here and change the scenario used, if I change it to best case, you'll see the figures, they change, right? So that's that. And so if I have the forecast for the year ahead, I can calculate what the actual value will be, which is equal to last year times the growth plus 1. And I can again ensure that that is comma separated, and I drag forward, so this will do into the future. So that one is done. I'm going to do likewise for other revenue. So other revenue, I'm also going to do all of this. I come here and I pick. Other revenue stands for revenue that the company makes but not from their core business line. So say maybe you have a head office that is a 10-story building, you're a manufacturing company, but then you are not using the entire 10-story building, you rent out 2 of the floors. That is revenue. Rental income, that rental income is other revenue. It's not from your main services. So you will want to forecast that differently from your main services. Since the formula for the year-on-year growth are similar, I'm going to just pick this and paste here. Now you see it comes up with div by 0 error, which is understandable. I'm dividing a figure by 0, nothing that exists, and so it comes with that. If you don't like that, you can wrap it in an if error and say, if error should come with 0. So you can do that if you are very particular about not wanting to show that div by 0 error there. Likewise, I'm going to say in the future we are not making any forecast. And since the company doesn't have other revenue, well, I don't think it makes sense for me to create some forecast ratio for that to say they will grow what they don't have, right? So I'm just going to say this is 0% all throughout for this, so that way we are not forecasting them as growing. I can copy all of this and paste here, and it will replicate what we have done. And in the notes I will say taking as non-existent. Okay, so I'm done with the other revenue one. I go to the next item. So the cost of sales, cost of goods sold. So I can copy that, come here, cost of goods sold, and then all what we did before, I go and provide the historical. So cost of goods sold, I make it to be in comma separation. I drag into the future. So for cost of goods sold, again, if I have a schedule, if I know what their unit costs are, and then the volume projected into the future, that makes a better forecast to use. I will just plug in those figures directly from the cost of goods sold schedule. But if I do not have, then what is a better rule of thumb is to forecast it as percentage of revenue. So typically companies have a very sticky gross margin. There's always a percentage of their revenue that is used to buy the raw materials, so it kind of stays a bit constant, and so that way you are able to do a much more reasonable forecast when you do not have insider data, when you do not have the breakdown by unit cost and by volume projection. So that's what I'm going to do. I'm going to say as percentage of revenue, and then I'm going to do all of this again. So as percentage of revenue means I'm going to pick the expense, divide by the revenue. I can make it as percentage, I drag it forwards, and then I can use the same approach of moving average, right? So I can copy all of this and paste here. Maybe the only difference is I don't think I will use a whole 5% up and down, right? Because typically you can't bring down your cost of sales as percentage of error drastically like that without some really interesting changes, especially a company that has been around for long. So I'm just going to say maybe up and down by 2%. So 2%, 2%, and let's see why this is not changing. Okay, so I'm going to say it should pick from here. I drag it down. I'm going to say this should also pick from here, and I'd also drag down, and we can again use that index formula, and for this one it's going to be the percentage times the forecast revenue, and that gets us what it will be for this particular forecast here. And so like this, I am done with that. I go to the other item. So typically it might be more prudent to bundle all of these as operating expenses. So I'm going to say maybe operating expenses net of D&A. So operating expenses, so I leave some 2 spaces. Operating expenses net D&A. Okay, less D&A. And then I go pick the history. So the historical is going to be the summation of all of this. I let it keep that comma separated format. Again, I have liberty of choosing a year-on-year growth or percentage revenue if I do not have any specific data as to what the company has planned as regarding their operating expenses into the future. So I think I will use as percentage of revenue because most of the companies I've consulted for, they typically have this plan to keep operating expenses at not more than maybe 20% or 30% of revenue. So this can also be a better way of them, making forecasts into the future if you do not have specific breakdown of all of the operating expenses. So I'm going to use that percentage of revenue approach, and all what we did here I will redo. So as percentage of revenue means, since I know I'm going to be doing some things as percentage of revenue, some things as year-on-year growth, I can make my life a lot easier by doing this formula in such a way that I can copy. So I can go here, modify that. Okay, this should be partially locked, so I'll be able to copy, and I can drag this way, and so that way I can paste that here without having to redo the entire formula. So Dangote Cement typically spend, between 10 to or 9 to 8, so far 9 to 18% of their revenue as percentage as operating expense. So I'm going to now use the same approach. I can say it goes up and down by 2%. So, and then again, since I know I'm going to use this formula of multiplying this by this, I can also lock the part I don't want to change, so more like mixed referencing, and I can paste here. If you don't know all these, no problem. It just means you will spend a little more time typing the formula again and again. But because I'm recording, I want to be as fast as possible so that this video doesn't get too long. That's why I'm using a lot more of those. It doesn't mean that if you don't do it this way that it won't work. Okay, and I make progress into the future. So the D and A, the depreciation and depletion and amortization. If you have the company's uh, capex plan, and then you have their asset register, and you have their depreciation schedule, then this becomes again what you will use instead of using this rule of thumb of having to do some ratio projections. I don't have any data regarding Dangote's operation beyond the fact that I know that they have been aggressively expanding for the last couple of years, and right now Dangote is in all of the countries his plan is he wants to be in Africa, and so it is now they are ramping up production. They are trying to reach their factory utilization. They are no longer expanding. So I will expect that maybe the the capex will not be as high into the future as it was in the past in terms of growth rate. So let's again plan for the D and A. I can decide to say it as percentage of revenue, because we typically say that a company uses assets to generate revenue. So that's why we even have asset efficiency ratios like asset turnover, return on asset, things like that. Well, maybe not return on assets in that it relates to profit, but definitely asset turnover. You want to know how well a company is effectively using its asset to generate revenue. So using that logic, you might prefer to use as percentage of revenue. The more revenue you want to make, then maybe the more expansion you have, and then also if you want to keep making the same revenue, you might have to keep replenishing your assets, cars you use, factories. You might have to keep replacing them in the same value as you used to have. So I'm going to use as percentage of revenue, but like I did mention, it's always more accurate to use a schedule if you have access to the company's schedule or plan as regards capex and how they do their depreciation. All right, so without wasting too much time, I'm going to again copy all of these, paste here. I'm going to go and pick the historical, what they've been doing before now. I'm going to say this should be comma separated. I drag into the future. I do as like I can copy all of this. I can even copy all to up to this, then paste here. I can and for the so right now it's let's try with the moving average and see. Paste all of these here. These figures are really high. This is showing as if they are still expanding into the future. And like I did mention, they are no longer expanding at this point. They are trying to bring up all of their operations in Ethiopia, in Cameroon, and bring them up to factory utilization level. So I am expecting the D&A as percentage of revenue to be smaller than what it currently is. So I can do that. I can say I expect it to be smaller. It should be, I can give a flat figure. Maybe I expect it to be 8%. Okay, I expect it to be okay. Let's see. This is crazy small. Let's say 9%. Yeah, maybe this is reasonable enough. And then I again specify what I have done. Since I know I'll keep dragging this again and again, I can make my life easier by by removing the dollar for the numbers part, so that way the thing is able to copy and paste without me having to always do this every time. So for the numbers part, let me just verify if I did for this. Okay, so I didn't do for this. That's part of the issues that happen with not doing that. I also again, this is just to make my work fast, not really like you must do it this way. So if you don't know how to do this, you can always type it afresh like I did in the first case. This is, like I said, to make me faster and the video shorter. Okay, so I go on to the next item there. Is the financial income slash expenses. So I can copy that. I can so financial income, they are an expenses. But some other times you could see companies, especially those strictly following the IFRS, they split them into two different lines and do the net. So I just pick the net here. So the financial income, interest earned on financial assets the company has. So maybe the company has some investment in treasury bills, maybe borrow some subsidiaries money, lend some other companies money, or invested in some shares and they got dividend. That comes in financial income. And then whenever the company borrows money, the interest they pay on the loan they have taken, they are the financial expenses. So you see, they typically don't have anything to do per se with the company's revenue as much as the company's strategy. Is the company wanting to leverage, then they borrow money and pay interest on the money they borrow? Or is the company wanting not to have any debts, or they are the kind of company that they can't even cheaply access debt? So it's more of a company's strategy than a company's so in choosing between percentage of revenue and growth rate, I'll prefer to choose growth rate. But then ultimately, if I have the company's plan, if I have their debt schedule, and I also know their plan as regards where they keep their cash, what interest they earn on their on the accounts where they put most of their cash, right? Then that makes life easier, makes things a lot more accurate. I can pick specifically for the future from those schedules. So I do not have them, so I'm going to stick with using year on year growth percentage. Okay, so I go here and pick historical. I tell it to show as that comma separated. I drag into the future, and then I do the growth. So since I have done it here, I can make things a lot easier for myself by copying all of this and pasting here. And then for the future, what do I think? If I do not have any plan, any knowledge of the company's debt structure, plans, and interest they earn on income, well, one common thing I do is I just maintain status quo. I say I put as 0% growth rate into the future, and I write it in the notes that taken as 0% growth in the forecast years. Okay, so with that, I can replicate the formula we use whenever we use year-on-year growth. So I'm saying the company maintains their debt profile, maintains whatever it is they do up to now, they keep the figures the way it is. So it's not too much of a worry as to accuracy. The only way you can be accurate beyond this is if you have insider information, you have plan as regards to the company's financial debt plan and investment plan. So which is the next after this? That is unusual items. So unusual items are, before we do call them extraordinary items, things that happen that you do not have control over and you can't easily forecast. So that's how they are different from other revenue. Remember the illustration I gave as regards an example of what you classify as other revenue. So I have a 10-story building HQ. I rent out 2 of the floors. I have control over that. I can predict how much income I will make from those rental spaces next year. The only thing is I will not forecast them the way I will forecast my main business line. But for unusual items, you are not expected to be able to know upfront all that will happen into the future regarding them. So an example could be actuarial gain. Maybe some of your insured properties, cars, got engulfed in fire, destroyed, and then you have to claim from insurance, and then what insurance paid you is more than the book value. You have to recognize that as a gain. So except you plan to go and get some of your properties born again next year, it's supposed to be difficult for you to forecast how much will come from it in the future. And so you have other things. Maybe you got fined, you won a lawsuit. So there are things that are exceptional that typically you put there. So for us, I am going to for this modeling, I'm going to use what we did for the financial income and expenses. I don't have any knowledge of what will happen into the future regarding them, so I'm going to keep them as 0, right? uh, so typically there is always this argument of, if you don't have a specific figure, should you use percentage of revenue, should you use year-on-year growth? And in some of the training classes I've had, I've found that the people who go with the year-on-year, with the percentage of revenue, has a more compelling explanation. So they say typically your all those unpredictable actuarial gains you got fined, it has a lot more relation to your size of business than just any other thing. So a bigger business will typically have a larger value in these things compared to a smaller business. So I buy that the explanation, and I can decide to use as percentages of revenue. I go pick the value from historical, drag into the future, and I can use, as we have been doing for the ones that are year-on-year growth, percentage of revenue. I then also maybe pick all of this. Now if I do not know what will happen in the future, then like I did for financial expenses, I'll keep them as 0. Okay, and then I can say as 0 for the forecast. Yes, and I can go pick the kind of formula we use whenever it's percentage of revenue. Let me just verify if it's doing it properly. Yes. Okay, so this is done, and I'll do for tax. So for tax is a bit uh, not as straightforward as all what we've done before now, because for tax you project using the tax rate. Okay, so I go and pick historical. So Dangote has been enjoying a lot of pioneer status and tax credit and such like. So you see it's only the years they pay, well, the year that they carry it as payment rather than credit, that you see it as negative. So the negative should be the norm anyway. Once their tax credits runs out and those concessions they have run out, you will see it show more negative into the future. All right, so what's the tax rate? Well, the tax rate is going to be, what you paid. So your effective tax rate, what you paid, divided by your profit before tax. Okay. So I can do this into the future. I mean, for all of the past, but I can't straight away just drag it like that into the future. So let's do for the forecast part. So for Dangote Cement, they've been enjoying a lot of tax credit. So that's why the in Nigeria, the statutory tax rate, the company income tax rate, corporate tax rate is 30%. And then also there's this compulsory education tax that you must pay, which is 2%. So typically, if there are no timing differences and all of that, you'll be having an effective tax rate of 32% on your earning before tax. But then because of tax credits, timing differences in recognition of assets, capital allowances, all those things that happen between your accounting tax and what the tax officials actually estimate as your tax rate, you find out that on the book there is always this difference between the statutory rate and what you eventually pay, which is now the effective tax rate. Okay, so I'm going to make my projection based on the effective tax rate for when I look at the other companies that have been existing in Dangote's industry, which is the cement manufacturing industry, for a long time, who are no longer enjoying any pioneer, any introductory concessions as Dangote enjoyed in the first couple of his existence, couple of years. I feel more compelled to use that over the historical one, because if I go and pick the historical one, it will be assuming that these concessions are going indefinitely into the future. So I can go with 16%. So when you look at Lafarge, you look at Ashaka Cement, you look at some of those other companies who already exist in that industry, what has been their effective tax rate? So in my own base case, I'm going to use this. I can take it up and down 2% like we've been doing for so I'm going to say taking as industry average of 16%, and then I can do this. In fact, I will do this and redo the 16% instead of having to go copy everything. Okay, so like this, and then I can copy this and paste here. For the future, I cannot estimate, do the projection for the future right now because we do not yet have the income before tax, the earning before tax. So this is where we stop for income statement projection ratios. Okay, so I'm done with this. I'm going to go to the balance sheet projection ratios. And like I already mentioned, I like to turn off the grid lines. So it looks a lot neater, right? Okay. So I go to the balance sheet projection ratios. Balance sheet projection ratios. And for the balance sheet projection ratios, I just to check that this is recording. Okay, so it's recording. Yeah, great. So for the balance sheet projection ratios, similar thing like we did. So I can reuse a lot of what I just that I won't do the scenarios all over. The scenarios we've done here will push into the future for the balance sheet. So I'm going to just copy paste this, tell it to, then I can say this should be this here, here, and I can drag this backwards. So great. And for the balance sheet, these are the different lines that we will be projecting. So I can maybe make my life easier by copying all of this and pasting them here. And then I'll be deleting the ones that we are not going to, like fixed assets. No, these are calculations. So I'm going to start spacing them and deleting things. Current assets. Typically, you don't forecast cash. Cash and cash equivalents are going to, they're the balancing lines are going to come from the cash flow forecast. So I'm going to take this out. Okay. Again, retained earning is not going to be forecasted. Retained earning is going to be last year's retained earning plus net income. So I'm going to take that out. Other equity items. You can take this one out. So these are the line items I'm going to forecast. Alright, so I've spaced them well enough. Like I mentioned, it's always preferable if you have a schedule. So if I have the capital expenditure schedule, I can know how much the company is planning to spend on intangible assets. Intangible assets are things like maybe software, things that are not tangible anyway, that you can't hold physically. So software, um, even patent rights, things that the company acquires that are not tangible, but then they have to depreciate maybe their material in terms of the value, and then they have a usable lifespan, and then you have to depreciate them over those usable lifespan. And so if I have the plan of the company, great, I can put them into the future. If I do not have, we'll again have to do rule of thumb. So well, without needing to worry you too much, we will do rule of thumb. I do not have any internal plan of Dangote Cement. So if I was doing this for Dangote Cement, I will probably have to, if I'm doing this for them as a direct project, I will have to sit with the CFO sit with some key people there and ask what are their plans into the future, and then that will guide my projection into the future. So for now that I do not have them, right, I can say as percentage of revenue. Okay, so as percentage of revenue, and what has been the typical percentage of revenue? This divided by the revenue for that year as percentage, and I drag into the future. So I can use the average of the last 4 years. So we use that 1, 2, 3, 4. Moving average again. So I come here in the notes, 4 years moving average. And then I can say this times the forecasted revenue for that year, and what did I pick? This times the forecasted revenue for that year. And I drag this forward, so maybe this is it. And for the PP&E, I'm going to say again as percentage of revenue. If I don't have the schedule where I'm going to get the book value of the properties into the future, then this is what I will do. That they are always going to have to maintain a portion of a percentage of, to support the revenue. They will keep having to have similar amount of assets, fixed assets. Okay, so I go and pick the PP&E. I drag into the future. I compute again. Since I can copy from here, is just to ensure that I make some things fixed. So in this case, it is the numerical part I make fixed. So that makes my life easy. Instead of having to retype this entire formula, I can copy and paste. Like I mentioned to you, you don't have to remember to know how to do that. You can always redo it from scratch. This is to save me time. If you remember what I said, that Dangote Cement has been aggressively expanding into other countries in Africa, like South Africa, like Zimbabwe, Ethiopia, Cameroon, and Senegal, and such like. So they've been having to spend a lot on assets. Then, because it's a very heavy, manufacturing line, so you typically will spend a year or some years to build before you start producing, before you see revenue from the plant and equipment you've bought. So you see that when they do, the ratio goes up, comes down when the revenue starts coming in, it goes up when they expand again, and it comes down. And like I did mention, now is when they are going to be bringing up all of the factory to capacity, and they are no longer expanding into any other countries. They are everywhere. The only country he wants to move into is Nepal, and I think because of situations with his refinery now, he has put that on the back burner. So it's been, I wouldn't project the future as is, right? So I can decide to say they can just maybe do 100% into the future, or I do some gradually reducing amount as PP&E. But well, just to make the computation a lot easier, I can just do the 100%. And again, for this, I can copy and paste. So instead of going that far back, I can use this here and say taking 100% percent. Okay, so let's move on. For the financial assets are, well, more like investment assets anyway, that the company owns. They don't depreciate. They are not depreciated. So investment in other firms, in treasury bills, in such like anyway. And again, I don't know. It depends on the company's plan. So it's really more of strategy. Do you want to put your money back into production, or you want to place some of the money in some investment assets? So I can use year-on-year growth instead of percentage of revenue, since it's more of a decision the company takes regardless of the revenue position. So year-on-year growth this year divided by last year minus 1. This is a faster way than the other way. Is you do into bracket this year minus last year divided by last year, right? But then this can be faster. This year divided by last year minus 1. So that's why I use this a lot more. And like we did the other time, anywhere you get div by 0 error, if you don't want it to be there anymore, you can wrap it in if error. And I can decide to do likewise for everything here. And then I don't have any information into the future. I can simply say, well, keep it at 0% growth. So taking 0% growth into future forecast years, and I can do the growth, which is last year times growth rate plus 1, and I drag this into the future, so they maintain whatever it is they maintain as it is. For other fixed assets, so other fixed assets are other assets that are not intangible assets, PP&E, and so you could have like deferred tax assets, long-term prepayments, you know. So I'm going to use as, I don't know, maybe as percentage of revenue or year-on-year growth. I'm going to use year-on-year growth. It doesn't matter too much what we use here, because if you don't have internal information on the composition of the fixed assets, other fixed assets, then there is no logic you can use to defend one over the other. Okay, I'm going to go and pick the historical other fixed assets, drag into the future, do the year-on-year growth, and in fact, since I don't have information, I'm going to maintain as they are. So I'm going to say growth is going to be at 0%, so it just keeps being maintained. I'm going to say as taking as 0% into the future, taking as 0%. Okay, for inventory, you will have to project it as days inventory outstanding. Days inventory outstanding. So typically, how many days does it take you in converting your inventory to sales? So this is it's a very standardized way of forecasting your inventory. So I go and pick the existing inventory. I drag into the future well, drag for the existing years. So the formula is inventory. Maybe I should just write it so you can see what the formula is. So DIO, days inventory outstanding, is equal to your inventory over your cost of goods sold, because that's what is tied to your, when you sell off, when you convert your inventory to sale, it is the cost of goods sold account that is the balancing side of that transaction, then times how many days in a year. So typically we use 365 days, and so I'm going to do exactly that. The inventory divided by the cost of goods sold, right, times how many days in a year. Maybe I take out the decimal point. So it's showing in negative anyway. 1 minus 121. If you worry too much about that, maybe we can put a negative before it. So you see, it takes Dangote 121 days to convert inventory into sales. And then if I don't have any information into the future, I'll expect whatever inventory situation they have persist into the future, except if I know they are improving their supply chain, they are trying to cut down on inventory holding, more efficient, then I'll maybe adjust it downwards into the future. But if I do not have any of those privileged information, just you pick the last actual and drag into the future. So I can see last actual projected forwards. So I just use the last actual as is into the future. Then, so if you remember how to change subject of formula, this is a situation where I know this, it's already in our income statement. This is the one I want to know. So it will be this times this divided by 365. So, and that's what I will do, equal to the DIO times the COGS for the forecast year divided by 365. And because of the minus that I needed to show as an expense, put back that negative, and then so that is done. What I said about the minus show as expense, no, the explanation is wrong, but the logic of what I said is correct. If you don't put the minus, right, it will come as negative because the cost of goods sold is already showing as expense here. So for us to turn back the inventory into a positive value, that's why I needed to put the minus. So that way you get my explanation correctly. And then I do for trade receivable also. So trade receivable, I also compute for the days sales outstanding. So typically, how long does it take us to, or does it take Dangote to collect sales for revenue that have been booked? So collect the money anyway, collect the cash. So do the customers take 30 days on average to pay you? Do they take 10 days on average? So as you say, days takes your sales to be outstanding, and that's what we use in capturing the receivable. If people take 30 days to pay you, then you always have receivables worth of 30 days sales. So that's your days sales outstanding, and that's the logic. I'm going to everything here. Maybe I just write the formula so that way you can see. So days sales outstanding is equals to receivable all over revenue times 365. So it's equal to receivable divided by revenue. Revenue is here for me. Divided by revenue, and then times 365. So 19 days. I'm going to drag it into the future. And like we did here, if I do not have any information about your strategy, are you guys trying to get your money faster? Are you trying to give people payment plan? They can stretch the payment. So if you give payment plan, they stretch the payment, then your receivables will go up. Your days it takes you to get back your money will increase. And if you're trying to cut down on credit limit and force people to pay on time more, then you expect it to go down. But without that information, I would expect that whatsoever uh, pattern is being exhibited right now will project itself that way into the future. So like we already did, you should change the subject of formula. It becomes the day sales outstanding times the revenue for that year divided by the number of days in the year. So that helps us to compute for the receivables into the future. So that's that one. Then for the other current assets, you could decide to use the sale days approach, days current assets, right? But if I don't know the composition, that is debatable. So I'm going to use the year-on-year growth approach. Whenever I don't know the composition, I typically use the year-on-year growth and keep the actual like that into the future. So I'm going to go pick the other current assets. Other current assets. I drag for the future. I do the year-on-year growth stuff, and I even keep it as 0 into the future. And I go pick I think at this stage I should take this out, it's blocking. Okay, so the company's share capital and such like, are they planning to raise new capital or not? If I don't know, I assume that they will just maintain status quo. But if I know they are planning to raise capital or buy back shares, then I can adjust into the future. So right now I go and pick the historical, and then forecast, I guess, and I can do the growth rate into the future. We keep it same. For the reserve, similar to, if I know the composition of the reserve, yes, I can be able to forecast. So the company have a, do they typically put a particular amount into reserve? So reserves could be things like the long-term liabilities, I mean employee benefits, long-term employee benefit reserve, could be even, it could be regulatory. So like for the financial institutions, there is this law that says they must always keep a portion of customer deposit in reserve. So there are many things that can be the composition of reserve. If I do not have any information and no privilege into the plan into the future, as I've already made clear, I always leave the past as it is into the future. Then other equity items, I'm going to use the same approach. I don't even know what it is that they have in their other equity items, so I'm going to just assume that they keep it as it currently is. They even do not have, so that's good. Then trade and other payables. So this is going to be days payable outstanding. These are the normal way of forecasting the working capital items. The formula is payable over cost of goods sold, because payable relates to your suppliers, the people who supply what you use in creating your inventory. So it's much more, it's tied to your cost of goods sold. So equal to payables divided by the cost of goods sold times 365 days in a year. Again, comes in a negative format. I'm going to maybe put a minus to make it positive, so you see the days as positive number. And like we did, if I do not have information about your terms of contract with your suppliers, I assume that whatever pattern you've been using in paying them is what will exist into the future. And then if I do change of subject of formula, it becomes the days times the cost of goods sold divided by 365. If I do it this way, the minus will be there. So if I want to take out the minus, I put a minus in front. And then I drag this forward. Okay. I can go again, say last actual projected forward. Okay, so I think we are making good progress. We're almost to the end. And then for the short-term loans, so the short-term loans, the company or loans that are due that current financial year. So long short-term loans, we start this. I drag into the future, and then again, if I do not have the debt schedule for the company, in the future I will do another example where we are going to build one that we are going to assume we have information about the debt schedule, the working capital schedule, the loan schedule, the debt schedule and loan schedule are the same, equity schedule, capital expenditure schedule, so depreciation schedule, even the cost of capital, unit economics. So we'll do another, I'll try and do another example where we will have to build these schedules from scratch. So that one will take a longer time and a lot of we acting as if we are in direct contact with management and we have those information. But for now, let's say we do not have those schedules. So what that means is if I do not know what your plan is as regards raising fund, borrowing, I will just say you maintain your current debt profile. Whatever you have, you keep refinancing the debt as it is. You keep the same value of debt on your book. So that's what I am doing right now. Okay. Then the current deferred tax is 2. If I do not have information regarding the timing difference and all those things to use to estimate what the deferred tax will be, then I can safely just do likewise and project the last actual forward. Okay. Likewise for other current liabilities. I'm going to keep as it is on the last actual year. Long-term loan, I'm going to do similar. If I do not know your debt plans, raising money and such in debt form, I'm going to say you keep the same debt profile. You refinance whatsoever loan you have, you keep same value of loan on your book. So I project this, and then keep it as it is on the last actual year. Likewise for other non-current liabilities, so things like the deferred taxes, deferred pay, long-term payables, I will do likewise. Okay, so I'm done with the income statement projection ratios, and like I already told you, I like to turn off those busy lines so it looks a lot nicer. And then with this we can be able to do our income statement, our financial statement forecast. So let's start with income statements forecasts, and to make my life easy I can pick everything as it is here, bring here, take out the parts that are not formula based, like this. If you remember, we had collapsed this to operating expenses, so I can maybe take this out, call this operating expense, less D&A. We can call this our gross profits. Can give it a top border, and it's going to be this plus this. Well, plus, because my cost of goods sold is already negative, I've been using this convention where expenses have been in negative, so that's fine. So you don't get confused as to why I did that. I can take this up. What did I delete? This is the one I want to delete. And so maybe this. Alright, so I can take this out. I can take this out. I'm going to take this out. I'm going to need the tax rate, so I'm going to bring that one here. Tax rates. Okay, so great. And then for the future year, so to make my life easy, I'm going to drag all of this 5 years forward. Let's see, this is 5 years forward, I guess. And then I can copy the way I did this, paste here. It's complaining something is referencing something else. Let me undo that. Okay, it's here. Alright, so great. Okay, so we are good to go. We I don't need this, so I'm going to take this out. I don't need for 2011. Okay, so this is good. And then this is going to be really enjoyable because I'm just going to come here, pick the figure, and then drag all the way down. Maybe make this big enough to show. Okay, not bad. I do likewise for other revenue. Come here, pick, and then I drag all the way down. For cost of goods sold, I come here and I pick, and then I drag all the way down. For operating expenses, I come here to our where we have done it. Yeah, this is it. I pick, I drag all the way down. For the D&A, I again come here. I pick, where is the D&A? This is it. I drag all the way down. For the financial income slash expenses, again come here and pick. So you see the work we have done there makes all of these a lot easy to do because this is the bulk of the strategic aspect. I drag all the way down. I pick the tax rates. Show as percentage. I drag all the way down. So for this one, you know, the tax is EBT times the tax rate, and I hope this is correct. Okay, and I drag into the future. So I'm done with the income statement projections, and just take a look at it. In 20, okay, the last forecast is 3.67. This should be in, let's see, this is millions, so this is billion, trillion, so 3.65 trillion, right? If I go change the scenario, so I change the scenario from best to say worst case. Let's go see if that will have, see, it has changed, right? Okay, so now you see how all what we do here begins to feed into the future. So to make this a lot easy for the users of the report, I can also make it obvious here what scenario we are running. So I can say currently running scenario it's my scenario, and then I put that index formula, and then whatsoever scenario has been picked, so currently running scenario, let's see, best, and then I want that to show on all of the I want it to show here, so I can come and link to it from here, so whoever is looking at my work can easily know which scenario we are running. I also want it to show on all of the other sheets too, so say they are equal to this. Then I want it to show on the sheets also here, so I pick all those sheets, I say they are equal also to these. Alright, so that way whenever I change the scenario, right, I will be able to see it everywhere what scenario we are on. So that makes it a lot useful for the end user. So I'm going to continue. Let me just go and change it back. One other thing, this table of content I've done makes it easy for me to jump around. Maybe I have not demoed that for you. See, I can jump around. I can also decide to do me going back to the table I was in, so that the table of content, so you can go back to the table of content from wherever you are. So I'm going to do that table of contents. I'm going to say that these should link back to table of contents. So that way, whenever I click on this, it takes you to table of content. And I want that to happen to all of the other sheets. So I'm going to copy this, then I paste here. Then I also paste in these ones too. Okay, so I paste here then. Right. So I guess that makes sense to do. So we continue. I am done with the income statement, and as usual, I turn off the grid line so it looks a lot neater. Then we proceed to the balance sheet. I'm going to again copy all of these, inclusive of the check. I go to balance sheet forecasts, I paste, I ensure that the column widths are respected. I say this is the balance sheet forecast, and like we did the other time, I take out all of the things that are not calculations. Okay, so this is good. I also make this to read into the future. So 1, 2, 3, 4, 5. And then I take these parts and put here. Okay, so we are good to go. I'm going to maybe just slightly increase the size of this. Okay, so for the intangible assets, I can come here, pick as it is here, and I drag all of the way into the future. What's wrong with oh I need to take out 2011. We don't have 2011 in the forecast. I did, so I'm going to take this out. On the projection side, I didn't start from 2011. We started from 2012. Okay, so I redo this now. In the balance sheet projection ratios, intangible assets, I pick it and then I take into the future. And then for the PP and E, again likewise pick it, then I drag into the future. For the financial assets, I come here, I pick it. So you see, this is quite straightforward, right? I drag into the future, I pick the other fixed assets, I drag into the future. My legs are shaking, let me sit down. I've been standing all this while. Okay. I do for the inventory, I pick it, 3, and then I drag into the future for the trade and other receivables. Likewise, I pick, and then I drag into the future for the other current assets. I pick, and then I drag into the future for the cash and equivalent. I'll have to go and pick for the historical from the historical balance sheet of 2012 and drag into the future, but not into the forecast years. So for the forecast year, is going to come from last year opening, which becomes this year's opening cash, plus the net cash flow from the cash flow statement. So we'll have to complete that when we are done with the cash flow. I continue with the share capital. Share capital, I pick, I drag into the future. The reserves, I pick, and then I drag into the future. The retained earning, so likewise for retained earning, I will have to go and pick from history. I drag for up to the actual, but then for the forecast, I will need to compute it. So retained earning is last year's retained earning plus net profit for that year. So net profit for this year. Okay, so that's I drag into the future. And other equity items. So this is kind of saying they are not paying dividends. So if they are paying dividend, maybe dividend will be part of other equity items that we net out of retained earning, or you can take it out directly from. So you will say this minus dividend. So for a company that I have their dividend structure and equity plan, I typically will have created an equity schedule where I will have taken out the dividend, and if they have preference shares and all of those things, I will have taken them out and then bring the retained earning from that sheet, which will be net of those dividends to ordinary shareholders, and if they have any preference shareholders, to also them net of all of those deductions is what I will now add on, bring here into the retained earning line. But for this one, we don't know of Dangote's dividend plan. So if they decide to pay dividend, right, great. It's still like your money they are giving back to you as the equity owner anyway. So I do for the other equity items. Other equity items. Where is that? This is it. And I drag forwards. I do for the trade and payables and other payables. I pick and I drag forward. I do for the short-term loan. Short-term loan. I pick and then I drag forward. I do for the deferred current taxes. I pick and I drag forward. I do for the other current liabilities. I pick and I drag forward. I do for the long-term loans. I pick and I drag forward. I do for the deferred taxes. I pick and I drag forward, and it's not balancing, so something is amiss somewhere. So let's see, what have I missed out? Okay, so I'll go back to the actual and go see which is correct, where I'm having, so it's 5, this should have been 5, no, 6 7 3, 6 7 3. So let's see, 6 7 3. So this is correct. This is where I must have picked something wrong. So in Excel, whenever I have issues like this, I typically split my window. So I'm going to do new window. Then I'm going to say one should come to the right, the other should come to maybe the left. Okay. So, and then I can compare. So I can take this to the historical, and then I can start comparing where things have gone wrong, particularly this line. So I start comparing and seeing where there are differences. This is where things are different. So what did I pick? I think I picked the wrong here, so I should have picked this. Okay, so once I pick that and I make the correction, I want to correct it up to here. Okay, so I can close this, save my work. I can close this second view, re-maximize that one. So okay, great. You will notice that for the forecast years, it's not, the balance is not, it's not checking out. You know, this is total liability minus total asset. They should equal. They should. That's why it's called a balance sheet. They should balance out, right? So it's not balancing for the forecast years. Not unexpected, because as you can see, we've not done the cash and cash equivalent for that particular period. So until we do the cash and cash equivalent, until we do the cash flow and all of that, then I can't say for sure if something is wrong or not. So let's go do the cash flow. For the cash flow, by the way, I like to turn this off. Okay, then I save. So for the cash flow statement, we are going to use the indirect approach. So the indirect approach is we're going to extract from both the income statement and the balance sheet. So I'm going to just take this out and put here, and I'm going to tell it to keep source width. So I'm going to break this into cash from, there are 3 categories of cash flow that you want to extract. There's a cash flow from operations. So the cash flow from operations is the net income, the net profits, and then you make non-cash adjustments. So I'm going to add back D&A. So I'm going to add back. So you notice I'm pressing a single apostrophe before the plus. If you don't do that, it will not keep it that way, to think you are trying to do a formula. So D&A, I'm going to also adjust for other non-cash items. I'm going to take out the interest expense, so finance expense. So if it's a finance expense, it's plus. If it's finance income, it's negative. Okay, so I'm going to take that one out. I'm going to also the working capital changes, right? So the changes in asset brings down your cash. So typically when you buy a car, which means you now have more assets because you bought a car, you bought a land, you've spent cash to acquire them, right? So change in inventory. So if I have more inventory, I must have consumed cash in getting more inventory. Change in receivables. And I'm going to add change in maybe before I go to that, even changing other current asset, changing other current assets. Then I can start with, so when it's a liability, if you borrow more money, then you have more money. So if you owe your suppliers, which is payable, it means the money you should have given them, you are keeping it with yourself, meaning you should have that as an increase in your money in your hand. So change in payables. Then generally changing other current liabilities. And is there any other thing I've omitted? Let me just take a look at my balance sheet. I think this is captured, this is captured, and this is captured, this is captured, this is these are what I will just put together as change in other current liabilities. So I'll take these two together. Or maybe should I do them separately? We'll do them together. Okay, maybe we'll do them separately. I can't seem to make up my mind. So I'll do them separately, at least so we keep that transparency there in our model. Okay, so all of this is now what I'm going to put together to get the cash flow from operations. Then I'm going to extract also cash flow from financing activities. So this could have been written as cash flow from operating activities if we want to keep to that convention. Okay, so this one deals more with capex. No. Change in investing activities. Sorry about that. So this deals more with capex, capital expenditure, change in long-term assets, change in long-term liabilities. So those are the things I'll bring in here. So things like what you spend. In fact, this finance income, I should have brought it here, but for now, I'm just going to leave it as, since we didn't separate them out here. So I'm just going to put them in the finance expense part of financing. Okay, so capital expenditure, capex, which is actually change in changing your fixed assets and the rest. So change in depreciable fixed assets. So change in PP&E, PP and intangibles. Okay, so I can take both of them as our capex, and then also by the way, this will be negative since when you buy. Then also any other thing that falls in our long term, let me come check. So for long term my other fixed assets. So if other fixed assets goes down, financial assets, so all of these I'm going to also move them there. Change in financial assets, change in other fixed assets. So plus change in financial assets. Did we buy new financial assets? So this will have been investments we made. So investment, that's change in financial assets. Change in fixed assets, other fixed assets. So do we dispose of anything? Change in other fixed assets. So this is capex slash did you sale of assets. Slash sale. Capex slash sale. So that you don't get too much of let me write it this way then. So change in other fixed assets. Let's see what other line items. Yeah, so change in long term liabilities, other non-current liabilities. Okay, so that will give us the cash flow from investing, then cash flow from financing activities. So we talk about the finance expense or interest expense. So debts repaid. So debt repaid, or let me use this way, increase slash decrease in debt. Okay, then let's go check that the company issue shares. Share, yeah, just right, equity issuance. Equity capital. Shares issuance slash buyout. So this makes better sense. What other items here? I'm just going to bundle together everything in this I will just say changes in other equity items. I'm going to bundle all of these, huh? I'm going to bundle them as that, so that way it's faster, right? Okay, so that becomes my cash flow from financing, and with that I'm going to be able to get the net cash flow. So net cash flow. Okay, and when we are done, we are going to also extract. We will do a check anyway, so we're going to do a check, opening cash flow, closing, opening cash, closing cash, and we will check if what we have done is correct. So I'm going to do a check here. Then after that, we're going to extract the unlevered free cash flow. So to extract that, I'm going to extract the free cash flow. So cash flow from after you've carried out your operations and investing activities, whatsoever asset you need to replace, capital expenditure. Then I'm going to remove interest, tax interest cover, effect of leverage anyway, so that's why it's called unlevered free cash flow. So to do that, I'm going to need to say what is the EBIT. No. Anyway, find out, yeah, EBIT. Then I'm going to get the tax rates. Then I'm going to get what you actually paid as tax, operating tax that you will have paid if you didn't have any interest that is tax deductible. Then what you actually paid, tax paid. Then what is the, I'm going to remove the tax interest cover, interest cover that you get due to tax, due to the interest cover that you get because of the debts you have. Okay, so I'm going to make this bold, make this bold, make this bold, make this bold, make this bold. And I'm going to increase this. Okay, so I think this should be good enough. Yeah, this is good. Alright, so I go bring in the income statement. From the income statement, the net income. And as usual, put the comma style. I drag all the way into the future. I forgot to include notes here. So notes, okay. And then I add back the D&A. Since the D&A is already showing as an expense in my income statement, we want to take out the negative so it comes as it should be. So it comes as then the finance expense also, since it's already showing as a negative in my income statement, I'm going to also want to take out that negative part of it. So finance expense. Then the change in inventory. So for change in inventory, I don't have 2011 in that other side, so maybe I'll just go do it in the historical. Okay, not to complicate things, we'll skip for the 2012, we'll do for 2013. So I go to balance sheet, I do inventory this year minus inventory last year. I tell it to be in comma style, I drag it all the way into the future. For the receivables, likewise, I'm going to go here, my balance sheet, receivables, where's receivable? This year minus receivable last year. I drag it into the future. Then for the other current assets, this year minus other current asset last year. Again, I make it comma separated, I drag into the future. Then payables, likewise, payables last year, where is it? Payable this year minus payable last year. I also make it into comma separated, I drag into the future, and other current deferred taxes. So current deferred taxes this year minus what it was last year. I remove the and I drag into the future. Then change in liabilities, in current liabilities, in other current liabilities. Change in other current liabilities. This year minus last year. I then drag into the future. And so now I'm going to, since I didn't do for, I can maybe just take this one out so it doesn't disturb, it doesn't destroy the formulas. So this is going to be summation of all the ones I need to add up. These two, right, comma these last three minus the ones I'm going to take out. These four, I guess. 1, 2, 3, 4. Yes, 4. And then I make it bold anyway. So that part is done. And I do for the capex. So for the capex, you will have to remember that capex, plant property and equipment, they are depreciated. So what I mean is this: if in my books I have fixed assets PP&E in 2018, 2019, I have 200 million naira plant property and equipment, right? And then in my D&A account, my depreciation and amortization, if in 2019 we take out 20 million for depreciation, you will see that this 200 million naira, the book value will now be 180 million. So for me to correctly see changes, whether we spend more money to buy new asset, when I'm doing the minusing, the change in PP&E, it will be, so it's going to be last year minus, so it's going to be PP&E in 2018 minus PP&E in 2019 plus D&A in 2019, right? So if we bought new assets here, so book value is 240, you will see that this will correctly tell us that we've had to spend 60 million naira. So we've had to spend 60 million naira capex, right? So that's how the formula works. I'm going to do the formula right now. I'm going to say it's equal to PP&E. In fact, the summation of, because of the intangible and the PP&E together are what are depreciated. So the summation of the two of these two in the year before minus the summation of those two now in this year, but then we have to add the D&A. I said add and I put minus. It's deliberate because the figure of D&A is already in negative here, so I need to take out the negative. That's why. So this will correctly get me whatever capital expenditure was made. So it's just remember the formula. Don't worry your head too much about this one. It is this logic. Once you apply this as it should be, then you will always get the right thing. So that's what I have done here. Okay, so I'm going to drag that forward. Since we've done for that, I'm going to take all of these that I've written here, take them away so that we can do other things without them covering the screen. So investment, did you make any new financial investments? So it's going to be what was the book value of financial assets last year minus this year. So that's how you see for an asset. Asset is last year minus this year to get the correct sign. That's why you notice when we did here we had to minus them, and here since we are not minusing anymore, we just have to go ahead and do this sign that will come with the correct cash flow direction. So I'm going to drag this into the future. Then other fixed assets too. Other fixed assets last year minus this year. And I drag into the future. Other non-current liabilities. So I think there are two of them. So it's better I just do sum straight up. Sum of these two, which is current defer. No. This is the one that should have been sum, huh? So this should have been sum. So here should have summed the deferred taxes, current deferred taxes, and total, because those two are the ones that have the remaining for the current liabilities that have not been captured already. So yes, like this, yes. Okay, so this one is not the one with the sum. What have I done? I just remembered I have separated them out. I remember separating them. So please don't worry, it's correct. We've separated them out. So I can straight away do this. Now I see why I separated them out. So we can just do for these deferred taxes minus this. Okay, great. And I'm going to straight away sum all of these since we've already gotten them in the correct cash directions. Drag. Okay. Right. And then the cash from. So the interest expense. I can go bring it as is from here. And then the increase in debt. So there are two debts, so short term and long term. So I'm going to do both of them. This minus this plus this minus this. All right. So that will tell us the increase in both the short-term and long-term debt. Then the company issue new shares, so we can do that. This minus this. So it seems they did some share buyout there. And then the other items, so I'm going to just sum them all together. All of these minus all of these. I then drag. So there's going to be a small issue. the retain any side, right, is also part of these items. So let me just say changes in retain earning, reserves, and so makes it easy, though it looks longer now, but then makes it easy to read. So in a company, so your retain earning in 2018, if it's 100 million naira, so in 2019, if you make a profit, so net income, if you make a profit of 20 million naira, it gets added on your previous retained earnings. So it's going to be these two plus. So you will have 120 million naira in your retained earning. So if I really must factor out the changes in it, maybe dividends you paid out, things that actually happen to the retained earning outside of the net profit that has been added, right? So the formula will be doing this year, so retained earning this year minus retained earning last year plus net profits, net income this year. So that's how you will be able to take out if there is any things you've had to settle from your retained earning, or you got some money that get added to your retained earning. So I'm going to have to do that. I'm going to have to take out from exactly what I've said. I'm going to have to say this year, which is that this year, minus retain any and all of that for last year, plus the profit for this year. So the net profit for this year. So that's the correct way to. So that is it. And then with this I can compute the net cash flow. Cash flow from financing is going to be the summation of all of these. I make bold, I drag into the future. And then I am going to add up all of these: cash flow from operations, from investing, from financing, to get what the net cash flow is. That also I make bold. And then I'm going to now check if what I've done is correct. So let's go and pick the closing cash from the balance sheet. So the cash for the cash and cash equivalent in the balance sheet is the closing cash. So I can pick that and I drag into the future years, and the opening cash for this year is the closing cash of last year. So opening cash for 2013 is closing cash in 2012, and I drag that also here. So these two are coming directly from the balance sheet, right? So if whatever I have done is correct, you can see it's looking wrong. If whatever I've done is correct, if I do opening cash plus closing cash and I say minus the closing cash, it should come up to 0. Okay, so I'm going to so it's not coming up to 0, so I just need to just check out what I have done wherever there is an issue. So let's see, I pick this from the right places. So whenever there is this issue, is again is to check that I've picked everything from the right places. Huh? So I'm going to make this, place them side by side, and I verify if I have picked everything correctly. So I go to the income statement. Did I pick the revenue from the right sheet? I think so. Did I pick the depreciation from the right place? Yes. Did I pick the financial income from the right place? The financial expense from the right place? Yes. Okay, I think I've seen where the issue is. This, okay, yeah, it's correct. No, no. Inventory, so let's go to the balance sheet. Did I pick from the right place? B13 to E13. Yes, this is inventory. Yes. Did I pick the receivables from the right place? Let's go and check. Receivables E14. Yes. Did I pick the current assets from the right place? Yes. Yes. Did I pick payables from the right place? Pick the payables from the right place. Yes. Looking. Yes. Did I pick current deferred taxes from the right place? Current deferred taxes from the right place. Let's check. D31. Yes. Did I pick other current liabilities from the right place? Current liabilities from the right place. Yes. Did I use the correct signs? Yes. This is wrong. The finance expense went out, and so this should be an addition, not a subtraction. So add back the finance expense. So this should be addition, not a subtraction. So I'm going to modify that part to add this up to here and this. So let's see. All right, so that was the issue. All right, so that's, at least you get to see how I troubleshoot whenever I have issues. Whenever there's an issue, just calmly go through what you've done, and you'll see it could be you picked something wrongly, or in my case, I missed the sign. All right, so right now it's confirming to me that yeah, it's correct now, right? And then, yeah, as expected, this will not be correct, so I'm not surprised, because if we have not completed the balance sheet, then this will not be correct. So right now we have what we need to complete the balance sheets. I just come in here and say cash for this year is going to be cash at the beginning of the year, which is cash at the end of last year, plus net cash flow for that particular year. And I can drag this forward, and that we should, okay, so this is now balancing out. And if I check this out, yeah, so this is also balance. Yay! So now we're done with the major work. We're done. If you are just interested in financial statement forecast, this is probably where you will stop. But for us, we need to go further. We want to do valuation. So I'm going to have to do some extra work. I'm going to say I want to extract the unlevered free cash flow, because that's what we use for the DCF valuation. So I'm going to add up the cash from operations plus cash from investing. Okay, so normally this is the free cash flow. Free cash flow means cash that you have after you've settled out your You've settled out your operating expenses and investing expenses without having to borrow money. So money that your business generated, and then you've covered all of your mandatory obligations. So it is cash flow without the effect of borrowing and equity injection. So that is ordinarily the free cash flow. But for DCF, you need to get the unlevered version. So without the effect of any leverage. And interest expense. Well, not really interest expense this time around since we've taken it out. Tax. Tax is tax. Um, in, Interest expense is tax deductible, meaning a company that has debt. So take a look at it. A company that has leverage. So let's say there are two companies, right? So ABC Limited. The same ABC Limited, but this is version 2. This is version 1. So let's say version 1, revenue 200 million naira. So COGS say 60 million naira, right? Let's say operating expenses is 40 million naira, right? And now operating expenses plus D&A, so let's say that is it. So EBIT, earning before interest and tax, is 100 million naira. Now the same thing too for company B, version 2. The same situation. COGS 60 million naira. Operating expense inclusive of D&A 40 million naira. Now we have the EBIT 100 million naira. Now if version A does not have any interest expense, its tax is going to be, say, tax of 10%. Its tax is going to be 10 million and the profit is going to be 90 million. So that will be the net income, right? If version B, version 2, has an interest expense, there's a loan the company is servicing at 10 million naira. Because this is tax deductible, the profit before tax is going to be 90, and so when he pays tax of the same 10%, he's going to be paying tax of 9 million naira, right? And net profit of 81 million, paying tax of 9 million naira. Okay, so the thing I want to focus our attention on is this is a version without leverage. So unlevered, no leverage. This one has leverage. It has debt, and you will notice that because of that debt, this person is paying smaller tax. So this version 2 is paying smaller tax compared to this. I need to take out that effect. We've already taken out we've added back the interest expense, if you remember. So in our cash flow, you remember we've added back the interest expense. So if you add back the interest expense for this version 2, which is 10 million, when you add it back to this will be 91 million. So this changes to 91 million. 91 million, which is not true. It is not the same as this person's own. It should be 90 million if you don't have any interest tax cover. So we need to take out that leverage benefit that's making your cash looks like 91 million when you add back the interest expense, as against 90 million for someone who doesn't even have any loan at all. So that's what we are trying to adjust for here. So we want to get the cash flow without the effect of leverage, and we are going to now do that, what I've just said. So I'm going to calculate what it is that you will have paid if you didn't have any interest benefit. So what you will have paid will have been the EBIT times the tax rate, unlike the one where you have the interest expense that is deductible, right? Where you will now have to remove the interest before you now do the tax of the PBT. So that's why to get to that differences, I need to factor out what you will have paid normally. Transform a company that is like this on the right side to the company that will have been unlevered on the left side. So that's what we want to do. I'm going to take your EBIT, what you will have paid, well, what you will have been taxed on if you didn't have interest expense. For now, I won't worry too much about the unusual item. So what you will have paid if you didn't have the interest expense, right? Then plus, let's say plus the unusual items anyway. So plus the unusual item. So let's just say it this way, plus unusual item. So this, then what is the effective tax rate, which is this, that's the effective tax rate. Okay, then what you will have paid is this times this, right? And then what you actually paid, so what you actually paid is this. So the differences between the two is the cover you have. So the differences between the two is now that interest tax covered I'm trying to take out. The differences between the two is going to be so let's just see the way it would have to be. So the difference between the two will be the one without the leverage minus the one with the leverage. No, sorry, the one with the leverage on the right minus the one without the leverage. So the one with the leverage minus the one without the leverage. One with the leverage minus the one without the leverage. One with the leverage minus the one without the leverage. And because of the sign part, so the one with the minus this. Okay. And then I can drag all of this into the future, and then I can do that the unlevered free cash flow is this minus the effect of the leverage. So I take out the interest tax cover. Okay, so this is the cash flow we are going to use to compute the DCF valuation. So we're going to do valuation here now. DCF valuation. And for this DCF valuation, I need the weighted average cost of capital, the perpetuity growth, long-term growth rates, and I'm going to want to get for the different years what the cash flow has been. So I'm going to just pick these. I can okay. Why is it showing that? Sorry about that. Okay. I was checking where is this coming from. So I'm going to go pick this, the year. Alright, so that should fix that part. Uh, we don't want to worry ourselves about the past that much, so I can safely take out uh, the past because we're going to start from today forward, right? So I can take this out. Maybe let me just take out some of them, not all of them, at least for effects, to create an effect. So I'll say for these ones we are not going to do anything about them. Our work starts from okay. So what is the unlevered free cash flow? Then what is the discount factor? And with that I can get the present value of the UFCF. Okay, and with this maybe because I need you to enter some things here, I can deliberately make them very obvious. I can decide to include some border that will be white, and then I'll make it white. Now there's a problem. Also inside, as usual now. I made it white. I can't see what the colors are looking like. So let me bring them back as black. And when I'm done putting the no. Yes, I can now make it white. So okay, so yes, I have made it white. Okay. No. White, 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 white. Okay, so it makes it look kind of cool if you ask me. Bold. Okay. So for the work, we'll come to it anyway. So let's do all the main things we need to do. Okay, I can go bring in the unlevered free cash flow for starting from here. But no. From 2019, this is it. 2019. And then I drag into the future. Okay, so this is it. And then for the discount factor, that is this work, weighted average cost of capital. So work, which is weighted average cost of capital, is equity over equity plus debt times cost of equity, then plus would the space here be enough? Okay, let me do debt over equity plus debt times cost of debt, and because of the tax cover you get with debt 1 minus t. Okay, so this is the formula. In achieving it, we might need to go and extract all of these components. So we go and get the E, we will go and get the D, where we get the E plus D, the tax rates, the what else, so for the cost of debt, that is pretty straightforward. Cost of equity, you will have to use anything but CAPM is more commonly used, and this is how the CAPM is computed. So if you use CAPM for the cost of equity, it goes as is: risk-free rate plus the beta into long-term market return minus risk-free rate. So this. So for us to achieve that, then we need to get the risk-free rates, the beta, the market return. I think that's all right. So let's get at it. For the equity, that's total equity. We can get that from our balance sheet. Total equity for the current year. So this is it. Total equity for the current year. Then what about the debt? Debt is, well, all of the debt on the books. So that's for the current year, the short-term debt and the long-term debt. Short-term debt plus long-term debt. Okay. Then the addition of the two is this. The tax rate, I can go even use the tax rate we were using here, the effective tax rates. And then the cost of debt. For cost of debt, it's preferable to use the corporate bonds. So Dangote, just because I can't show you my inbox, I get emails from AfriInvest that they tell me all of the companies and their commercial paper and their current rate. And I also have this investment app where I can go and look up the different stuffs. I can say I'm looking for Dangote's commercial paper. Let's see if you can show you that Dangote commercial paper. Dangote. Let's see what this is. The debts stuffs. So debts. I'm still getting a hang of this stuff. Well, because of time, I'm not going to. I just wanted to show you where I typically get it from. But the last one I got was from AfriInvest, and they emailed me all the current rates of the commercial papers currently actively being traded, and I got it from there, and it was 14%. So I'm just going to plug that here. You can also go check their loans and the interest rate they pay on them. So this is more of research, you getting the cost of debt. For this one, the CAPM, we are going to have to get the risk-free rate. So in Nigeria, the treasury, the yields on treasury are around the 10, 11, 12. I'm going to say 11% is the risk-free rate. Then the beta, so for Dangote Cement and pretty much any company that exists on the Nigerian Stock Exchange, it's a lot easy to get the beta. Just go online and search Dangote Cement shares, and most of all the analysis links that come up, maybe from Bloomberg, from Financial Times, when you open them, these are one of the freely available informations they give you. They give you the beta. So let's see if I can see it here. Okay, Bloomberg didn't give me. Let's check what Financial Times, if it's there in Financial Times. Why is it taking this long? Okay, so I can see 1.180. So that's usually the fastest way, instead of you having to calculate variance and covariance and variance. So I can just plug that in there, 1.80 what? 1.807. So I'm going to close that because my Google Chrome eats up memories. Then for the market return, you will have to estimate what's the long-term Nigerian market return, since we are doing for a company that exists in Nigeria here. I have done it before. There is this formula that you can get what is the NSE. So I use the NSE All Share Index, what it is currently now, uh, and then what it was in 1993 when it started. If you There's a tutorial I did on it, you can go look that up, and then you can use that to compute what has been the long-term market rate of return for the NSE. So when I did it, it came to about 16%. So I'm going to put that here without having to worry us too much about. If I say I should do it right now, it will take a lot longer. I will have to go and dig up the. But I've done it as a tutorial blog. If you follow my blog or you're on LinkedIn, you can go read the steps up with the links. I left everything, the calculation there. So with this now, we can compute the CAPM. By the way, if you ask what's my blog, right, you can easily check on www.yourbizedge.com/blog, and also my website www.olafusi.michael.com, and I'm on LinkedIn, linkedin.com/. How does LinkedIn write once? Well, I think it's olafusi.michael.com. olafusi.michael.com. Right. So if you find me out, you can read it on my LinkedIn blog post. I think it's also on my blog, and it's on our company blog also. So I'm going to compute this risk-free rate plus the beta. Where's the beta times the market rate minus the risk-free rate, and that's so it comes to like 16.9 blah 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 for Dangote Cement. Okay. So now that we have all of the pieces, I can compute the WACC. So the WACC, which is what I want to compute right now, is equal to E divided by E plus D times the cost of equity, this one. All of this I'm going to put in a bracket, and then I'm going to say plus, in another bracket, the D divided by the E plus D times the cost of debt, then times 1 minus the, where's the tax rate, then these I close, and it gives me the WACC to use. Okay, so that's my discount factor. To make life easy, I can number these ones here, and then since I don't need all of these anymore, I can take them out. Also take this out. I'm going to also take this out. Okay. So right now, the discount factor is 1 divided by into bracket 1 plus the discount rate, right? Then raised to power how many periods into the future. So raised to power how many period into the future. So this is 1 year into the future. That gets me this. And if I do likewise, it's I need to lock some things. You see this has scrolled away. So I'm going to go back to the original formula. I'm going to lock this one, this work, so it doesn't go anywhere. So now I can scroll, drag it forward, and then the present value of all those cash flow is going to be this times this, and then I drag forward. Okay, and now I can say the cash flow from PV of explicit forecast period. So that's 5 years that we have forecasted. So all of the cash that has come from that period. Okay, so it's going to be equal to the summation of all of this. Okay, but we also need to get the terminal value. So the terminal value, it's now the company does not just die after 5 years. It's going to be in existence after 5 years, right? So there's a rule to how you can forecast for it. So you expect that the company can at least keep growing. So this UFCF in the 5th year, the company should be able to keep growing it. Let me write that to you very well. The company should be able to keep growing this at some long-term growth rate, G. Okay, so now when you have money that keeps coming like this into the future, right? You use perpetuity to value all of that money. And then it has a formula, which is you take all of that money, you divide it by the discount rate. But then in this case where the money is growing, it keeps growing into the future, so the discount rate minus G, so the long-term growth rate. So this is more like a growing perpetuity. You might have to read up on that if it's a bit confusing for you, but that is the formula, right? So this is how you estimate the value of something that keeps growing like into forever, and you want to get what's the value right now in today's value. So this will get us all of the money from year 6 forward. 6, 7, 8, like that. So whatever we get here, we have to again multiply it by the 5th year discount factor. So by the 5th year discount factor. Okay, so that's what we are going to do. How then do you get the G? There is no science, there's not so much of a science to it than just a framework that says no company grows out beyond the bounds of the inflation rate and the long-term GDP growth rate. So a company can never grow beyond the economy it exists in. Otherwise, you get bigger than the country, and maybe sooner bigger than the whole world. That's like saying a tree growing into the sky. So you will always have to say between the inflation and the GDP. So for us in Nigeria, that bounds is our long-term inflation. I can easily show you. So I have a tool that we are the owner of the tool. We created the tool. Is Nigeria market data. So if you launch it, to install it, you will have to go to insert. You go to get add-ins, and when you go to get add-ins, you will see the tool in get add-ins. You just scroll a bit. You don't okay, I think they moved it down a bit. So this is it. You click on add and boom, you will have it permanently in your own Excel like I have here. So once it comes up, I can use that to show you. So if I click on inflation, it will get for me all the inflation, and if I pick it, you see our average inflation rate has been 11.36. So that means in this bound here, that's kind of crazy high. Anyway, that's what it is. It is what it is. I can say 11.3. Then what about our GDP? So let's go and check that out. Our GDP, what's been our GDP growth rate? So if I do that for the last 30 something years, almost 39 years, it's 4.2. We have problem, huh? Our inflation is higher than our GDP growth rate, have 4.2. So any company in Nigeria, well, will have to grow within that bounds. You can't grow faster than this bound. So if I think what you produce is something that it's very essential, so you have power to raise prices, you're not going to be disrupted really quick, then I can be more generous in picking within the bound. I can pick maybe 7%, 6%. So let's say I pick for Dangote 6% for the small g. So I take this out, and then let me take all of this out of the view so we can focus on what it is we are doing. All right, so I hope you remember the formula. Anyway, I've taken out the formula. It is cash flow in the fifth year. Maybe I should just bring back the formula so that it makes it easier for you to see what I'm doing. Okay. So I need this formula then. Well, let's just say I take out the things around it. Alright. So this is the formula so I'm going to leave it as it is now so you can be able to follow along. So cash flow in the fifth year times, so it's growing, at that long-term growth rate, small g. I close the bracket. Now all of this I say is divided by the discount rate minus the small g. So that's all of this we have done. Then now I'm going to multiply all of that by the discount factor, this 50-year discount factor, to get me the present value of the terminal value of the company. So all of this gives me the enterprise value. So the company's enterprise value, it's going to be this plus this, and going to say I want this to have a top border. So this is the enterprise value. What if I need to get the equity values? If I need to get the equity value, then I will need to take out the financial liabilities, take out the debts anyway. Take out the debts, what is due to the, because enterprise value means, let me just quickly show us. So enterprise value, EV, means what belongs to both owners of the company, equity owners and the debt owners, because every company is a mix of these two capital structure, right? So if I take out what belongs to the, if I say this minus what belongs to the debt, then it will give me what is for the equity guys. So that's what we want to do right now. Then typically you have to, equity guys own the cash too. So I'll have to add back the cash at hand, and that will give me the equity value. So this will give me the equity value. I'm going to go and take out the debt. Luckily we have it here, so I don't have to go too far. I'm going to add the cash. I can go to the BS cash for the last actual year, this, and then I can make all of these have the commas style. So it will be this minus this plus this. That gets me the equity value. So I can go and grab what's the share outstanding of if I want to know on a per share capital. So shares outstanding, and with that I can be able to compute the price per share, or value per share, equity value per share. So what's the right price per share? Okay, let's go and grab the shares outstanding for Dangote Cement. So if I maybe go here, maybe this is a good opportunity to market InfoWare's product. I hope they pay me for marketing. So if I go here and I go to Dangote Cement, you can also search it online anyway. I just want to use this opportunity to tell you about their wonderful tool, though they charge. But what they charge is reasonable, I should say. And this is not a good time for it to disappoint me. This is not good. Okay, so I go to Dangote. Go. Let's say I go to commands. I say I want to do LV Dang Cement. So it's going to show me information about Dangote Cement, but I not just want to see the chart, I want to see everything. I think what's the guess I didn't complete my schooling for this, huh? I think it's QT. My head is there. So it shows me, let's look for shares outstanding. If you see shares outstanding, that's, oh, so this is it. 17, it's a lot. So 17.0405. Am I able to copy this out? Well, no problem. I'll come type it out one after the other. So the shares outstanding, maybe I'm going to write it in millions. So millions units. 17.040.507.505. Okay, so now if I divide the market cap, or the equity value anyway, by this, it will get me the what have I done? Okay, I think let's just check out if I've not omitted anything so far. Okay, so it gets me the value, what the company is worth. It's just that this looks outrageous, huh? So whenever I'm done with the modeling, I typically go and check my financials and see, is there anything that is looking very different from the past. Whenever I see, then I know it's a place for me to see adjustment. Something is wrong with the okay, so I've figured out the problem. The problem is with this. So this is supposed to be just this plus this. Okay. Haha. And haha. Voila, yeah. So and so that's been the problem. There was a miscalculation in here. So once I corrected that, it's looking a bit more reasonable. So if I go here, let's check out best case, right? Then I go to the valuation. Shows Dangote's valuation comes to 185 naira per per unit, okay, per share. So let's go and check out what is currently selling for. Selling for 155. So it says our model says Dangote is selling at a discount if you go with the best scenario. And if you go with the base scenario, let's check out what that equals. 129, so that is below this. And if you go with the worst case scenario, right, that comes to 89 naira per share. And so you see how all what we do here as and it's kind of close to even the valuation of the company on the stock market, right? And everything you change here, if you come in here and you make adjustments, so like this one where I'm taking it at 100, and if you check, anytime you make adjustments, it feeds always back into the model. If I come back here and I start switching between the scenarios, if I go to the base case, again this should have, so see, it has come to 149. If I go to the worst case, let's see what it has come to, 104. If I go to the best case, and you see it's 210. And so every time you make a change, it feeds back into all of the forecast side. And then right now we can be able to complete the cover. So as per the cover, I can show what the revenue will be for the different forecast years. Where does that start from? 2014, so I have to pick it. What the EBITDA will be. What happened to the revenue? That's interesting. Oh, okay. I picked the revenue from history. So revenue from forecast 2014. Can slightly increase it. Then the net income. So the net income from 2014. And that also I drag forward the current assets from 2014. Current assets. Drag it forward. The non-current assets. drag forward the total assets from 2014. I drag forward, so if I want this, the current liability from 2014, that's F. The current non-current liability, the total liability, so all of these I can drag forward to get for the future. Then the net cash flow, so the net cash flow from 2014, the unlevered free cash flow, okay, so the unlevered free cash flow, and okay, so and that is it. I can put a spark line in front of it to make it easier to visualize how it's been changing. So I can do a spark line, so you can be able to see how it's been changing. And what other thing will be nice to put? So at the end, like I told us, I like to turn off the grid lines. And you see, this looks really cool. So we are done with the whole financial model and valuation. Let me just take out all these things, and boom, and you can see that it's not too far off from what the stock is currently trading as, right? And for the financial ratios, you can decide to put in the financial ratios. I'm going to skip that for now, but I can point you in the direction of how to do that. So for the financial ratios, it's similar approach, but they are not going to be in millions. Why is this pointing somewhere else? Okay, I can tell it to have the effects of this. Okay, this is equal to this. So the different ratios, so there are 5 major different ratios I like to bring out. There's the profitability ratios, So right there, here you have gross margin ratio. Okay. Gross profit margin, operating profit margin, net profit margin, return on assets, return on equity. So those are the profitability ratios. There is also valuation ratios. So here you have price to earning, price to book value. So the PE ratio, the EPS, book value per share, book value per share, price to book value, dividend yield. So to compute these ones, you probably we need to get the current price that Dangote's shares is being sold at. There is also the liquidity ratio, current ratio, quick ratio, cash ratio. So these are the very common liquidity ratios. There's the asset management ratio, under it we have the average collection period. So that DSO I mentioned is the same as this. So that's DSO, days sales outstanding. Days payable outstanding. So typically a company will want to have collect its revenue faster than it needs to pay its suppliers. So you don't have your money hanging outside and you have suppliers you have to pay, and you don't have money to pay them, or you're having to borrow from bank to pay your suppliers. Days inventory outstanding, inventory turnover, how well you inventory turnover. How fast enough you consume your inventory. Fixed assets turnover, total assets turnover. There is also leverage ratios. So there is the debt ratio, There's the debt to equity ratio. There's the times interest cover, or times interest n, times interest end. So times interest end. There's These are the common ones. With the manual that those who have purchased our course have, you will see the formulas to compute all of these. And maybe just one last thing. I think here where I wrote interest cover, it should be tax the tax cover you get. So tax cover. Okay, so I guess that's the last thing to modify. So thank you very much, and I hope with this you've been able to get it might be a lot in a short amount of time, but then the good thing is it's a video. You can pause, you can try and do along. So for those who take our courses, you get the practice files you can work with. We even give you uh, other practice companies, real companies with their data to work on. Thank you very much.